Can you hear me?
Now I can hear you. I was just going to say I couldn't hear you.
Everything just froze on me. That was really strange. I'm like, okay, I'm ready to go. Things are good. All right. All right, hold on. Let me just make sure everything's good. Hey,
Technology.
hey, it's the new year, right? January 3rd. Woohoo! Happy 2022. I saw a really funny meme going into this year. Somebody said, all right, nobody claim this is your year. Let's just all walk in nice and slow and be real quiet. Don't scare anything.
Exactly. Exactly.
I
It'll be a
love
good
it.
year. It's going to be a fantastic year. It's going to
It
be a
is going
great
to be
year.
fantastic, and I'm excited to talk about this. So, what we have today, Vetted VA, I'm happy to sit with you. I'm Nathan Nottingham with Vetted VA, and with me is Hammer J. Helmer. And we're going to talk about some of the mortgage aspects of interest rates and markets and impacts and such. So, as we normally do on our weekly, we took 2 weeks off, celebrate the holidays. There was travel, there was family time, engagement, the whole nine yards. So, yeah, how do you want to kick this off, Hammer? What do you got you want to talk about?
Do me a favor, if you don't mind sharing the screen, we'll just go through and kind of do a quick forecast, recap of what happened the last couple of weeks, and we'll forecast where things are going this week and through the month. So, first things first, of
Perfect.
course, welcome everybody. Great to see you all. We did not actually have anything to worry about the last couple of weeks that we haven't been here, and that's why we didn't need to do anything. Things get very quiet towards the end of the year around the holidays. Markets tend to quiet down. A lot of investors take off the last 2 weeks of the year. Tends to get a little bit sedentary, just real quiet like. However, this morning there's a lot of activity. So we'll talk about that and what effect it's having on rates right now. For all of you that are on, you'll get to see it in real time. But quick recap for the last couple of weeks, mortgage rates were basically unchanged as investors, as I said, took the rest of the year off. However, this week, rates are going to remain low. I mean, we're not going to see a jump up to 4%. However, we are starting to see signs already this morning and now this afternoon here on the East that rates could get a bit worse. Most consumers aren't necessarily going to see an increase in rates this week, but they may see an increase in closing costs. In other words, when you go ahead and you select which mortgage rate you get, a lot of times your lender will be able to either provide you a small credit or it'll cost you a small amount, what a lot of people call discount points to get a particular rate as you move between rates that are available. And this week, we're probably going to see a little bit of worsening. And the reason for that, and I'll actually bounce through screens here. Here's all the technical mumbo jumbo for those of you that might want to look at this with me, and I'll explain to you what's going on today. So this morning, mortgage-backed securities are down 48 basis points. So, Hammer, what is that weird jargon that you're talking about? Well, what that means is that the the pool that lenders are selling their mortgages into is paying less. And when it pays less, the only way for them to make a profit is to charge more or to increase rates. So what we're seeing is that movement in the markets, and we'll kind of keep an eye on things to see if it levels out. But there's a couple of things here in these technicals that give us some signs of where rates are headed and why we think that's a little bit negative. So for those that may want to delve a little bit deeper into some of these funny little candlesticks, what we're looking at is that there's a level right here. And once we break it, when you look at these charts, when you break below certain levels or when you push above certain levels, they're called support or resistance levels. And these are all technical indications. These are technical indicators. So what we've seen is we broke below 101.73, 101.73. We're now at 101.59, which is a really bad sign. And what this is telling us is that investors are basically changing the range in which they're buying and selling these bonds, which is going to trickle over to the mortgage rates, which means rates will probably creep up a little bit this week. Like I said, nothing too major. You don't have to worry about if you've got a house that you're looking at or you've been considering things. Nothing is gonna make a big change for you, but you might see your payment get a few dollars higher when you go ahead and rerun numbers this week. So keep that in mind. Unfortunately, it does look like that's the direction that we're headed for the week, and we'll see kind of where that goes. We've got a couple of other things that will make a effect on this week's rates. On Friday, we're going to have jobs data. Jobs data is a big deal because right now, what's really driving interest rates, as we've talked about many times, has been the Fed. And the Fed has a mandate, what they call a dual mandate. They're looking to do two things. They need to maximize employment and they need to keep inflation in check. We all know inflation is out of control right now, real ugly. And in order to get inflation back in check, the Fed is going to need to raise their policy rates, or what they call the Fed funds rate. We've talked about that in the past. We won't get too deep into it right now. But the other piece of that mandate is the jobs and unemployment. And if this week's jobs data, which comes out once a month, comes out strong, that really pushes the door open for the Fed to raise policy rates sooner this year. Originally, it was expected that would be maybe in June. Now they're looking at May, and there's talk that it could be as soon as March. There's no April meeting. There's an end of March and then a beginning of May. So that's what they're kind of looking at. So as investors and markets are watching this and speculation grows around the Fed raising their rates, that could cause mortgage interest rates to creep up a little bit ahead of time. So that's about it. That's kind of what's affecting things. So with all that out of the way, what questions did you have, or anything I should clarify on that, Nathan?
Well, let's go here. We got one question in that says an MBS drop, mortgage-backed security drop of 45. How does that translate into pricing on rates? How would you walk through that?
We have okay, good, perfect. So we'll go back here. So the first thing you have to figure out is we're down right now. So we're down, like that person said, 45 basis points. But where did we start when lenders came out with pricing? What I'm going to do is I'm going to zoom in on this chart down here at the bottom. Oops, hold on. I just got us. There we go. Okay, so what this little line chart is this is yesterday. Everything to the left of this dotted line is yesterday, which of course is actually last Friday for the mortgage, for the bond world, right? So last Friday, we were up to this point, and then you see the straight line down. That's because the markets closed early on Friday at 2 p.m. So that's between 2 p.m. and this morning's open. That's what that difference is right there. Then everything to the right of this dotted line is today. And the reason I want to show you guys this chart is down here, you can barely see it, but there's a 10. This is what time it is, Eastern time. So it starts at 8 a.m., then there's 10 a.m., 12 p.m., 2, 4. So at 10 a.m., right around this part right here, this is when most lenders are starting to set their rate sheets for the day. And the rate sheet will either be higher or lower depending on where they were the day before and where they left off. Where rates came out in the morning, where they ended the day, that's where that rate sheet will generally vary. So once rates come out, generally, again, just a rough estimate of around 10 a.m. Eastern time, most lenders are going to begin pricing. When we see this line going down, 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 that's the move between 10 a.m. and where we're at now. That's where we would see changes in prices. So all 45 basis points aren't actually worked in all at once. What happened is we were down about 30 basis points this morning from Friday. So if you looked at rate sheets on Friday, or the rates that your lender quoted you, if you saw 30 basis point movement, give or take, what that means is on average, that's going to be about 0.25% in closing costs. So not in interest rate, but in closing costs. In other words, if you have a $100,000 loan, it would cost you an extra $250 to get the same rate when we have that basis point movement of about 30 basis points. Now that we're looking at 50, that equates to about $500 of difference. So if it was a $300,000 loan, that's $1,500 difference in closing costs that you could see between Friday's pricing and rate sheets and this morning's. Right. Now, it doesn't have to be that way. We've talked about lender margins. There's a little bit of play in there. But if you wanted a rough estimate, that will give you a rough estimate.
I think that's a really good breakdown and example. So thank you for doing that. Kind of about, and we've talked about this multiple times, but what an interest rate and then the credit, the amount of value that you can get from that interest rate coming back to you is really the thing that changes more than the actual rate itself in a speed or in a small micro segment, right? If you look at macro, you're like, oh, okay, well, the rate fluctuated, but micro, it's the cost of that interest rate over time. And the value you can get. And we're a traditional industry. We still work in these eighths. So in other words, interest rates for almost all lenders. There's one out there I know that actually prices to the decimal now, but most lenders are going to price in 0.125% amounts. So 3.00, 3.125, 3.250, 3.375. So it's a little confusing when you look at the mortgage business, because it doesn't just go up and down in that decimal. So you don't go from 3.27 to 3.29.
inflation, you go from 3.25 getting $500 back to 3.25 and it costs you $500. And that's where the difference comes in. And that's what you have to kind of pay attention to. We wouldn't want to make this easy for everybody. We still have to do it the old fashioned way.
You know, when I got into lending, my carpentry skills got a lot better because I was measuring on a tape measure. It's like, what's 1 1/4? Oh, that's 1.25. What's 1 1/8? That's 1.12. Oh, I got you.
Yeah.
So anyway,
we still think that way.
Let's talk about inflation a little bit. Let's talk about kind of what we're talking about inflation. Let's talk about building, right? So we know that there's a demand for housing still, and there is going to remain a demand. Most of the things I read going into 2022 forecast said, look, the demand is still there. It's not maybe as high as it was, but it's still on a trajectory of high demand. It's more demand than the market has. So construction is something we see a lot in VA. A lot of people asking about one-time close or purchasing from a builder. Like, how does that work? And they want to know. The question I have, I was reading an article, which one was this on? Mortgage News Daily, right? They just kind of push out new little tidbits here and there. And they were talking about the volatility of lumber, right? Pretty big. I've noticed it here. I was working on a project, went and bought a sheet of plywood, went back a week later, had to buy another sheet of plywood and was like, whoa, hold up. Like, that's another $6 on that sheet of plywood, same sheet, same store, week later. Like, that was pretty crazy. So I'm seeing it. What do we think that's going to do? Will that have any effect on mortgage interest rates, the yield, the spread, everything you talk about? Like, does the volatility of lumber, construction, have anything to do with mortgage rates?
It doesn't have anything to do directly with mortgage rates, but it is going to dramatically affect your affordability. So the rates could go lower because you need extra money to buy a more expensive house because of that price of lumber. And if rates start to go up, you're going to be able to afford less. So it doesn't directly affect mortgage rates, but everybody focuses on rates. But really, it affects your affordability for sure. And you saw that movement just in like a box store going to get lumber from week to week.
Mm-hmm.
Yeah.
Yeah, it was crazy. It's been blowing my mind, actually.
It's a big move. So let's kind of look at the housing industry and talk about new builds and what formulates into all that. So the first thing to remember is we have to go all the way back to 2008 to really get an idea of why things are the way they are today. So in 2008, we had the Great Recession, and that was actually caused by yours truly, the mortgage industry. And we caused it. Was Wall Street, but they used us as victims. And anyway, what happened is the housing industry tanked. And when it tanked, a lot of people, a lot of trades were forced out of the industry, and they had to go find other jobs and other careers. And what that did is it left a huge gap between what was done in 2008 and all these people and all these jobs in the building. And then there was about 7 years of just emptiness where there was not a lot of building and there was not a lot of people in the trades. And now we've got a boom again and there's a big demand, but there's not enough of anything to fill it. We've got lumber shortages, which it's funny because lumber, it's a lot like the price of gas at the pump, right? So we all feel the price of gas at the pump. You put that thing in your car, you put that nozzle in your tank, and you feel what's coming out of that pump. But that rolls back to, that has to go through a few different phases to hit you at the price on the pump. It's got to go through the oil price of crude oil by the barrel. Then it goes through the refineries and then the trucking and then the cost at the tank, at the actual pump. So there's these different phases that control what you pay, and they roll back. And it's the same thing with lumber. Lumber is, you paid for that $6 more for that plywood at the end of the week later at the box store, at the end of that chain. But to get there, a lot of people think we're short on lumber, and we're not short on lumber. There's plenty of trees. In fact, there's a problem where the cost for the tree farmers the costs have been driven so low, they're not making any money. And what's happening is we've got a log jam, and I use that pun on purpose. There's a dad pun for you. We've got a log jam at the producer level where the sawmills, where they're actually creating finished lumber. And then, of course, we also have, shortages of trucking and getting things to different places, and the costs have gone up there. So those are all the different variables that are coming into play for the cost of lumber. And that cost of lumber is only one variable in the cost of a new build in the house, because we've got lumber, we've got land, we've got labor,
Mm-hmm.
we
Mm-hmm.
got all the L's, right? We got them all dialed in. So I don't think that we're going to see the cost of houses come down, especially for new builds, for a couple of reasons. We're not going to see those L's change. Labor is not getting any cheaper. Lumber is not getting any cheaper, and neither is the land. And then on
Mm-hmm.
top of that, builders need to make a profit. And the problem is, builders look at building a house, and at a certain point, and I could probably, can you show my screen again? I'm going to do something on my
Yeah.
little, on my
Yep.
tablet. I want to show you guys this, if that comes up, and I'll show you. So I'm going to draw, a chart here for y'all. And on one axis, we've got the cost to build. I'm going to do this one as the cost to build. And on the other axis, we have the cost to sell, or the,
Mm-hmm.
yeah, I'll just call it cost to sell for now, but I'll explain it a little bit better in a minute. So the cost to build a house, but what you could sell it for, is actually what I was looking for. And I'm actually going to reverse these so that the chart goes in the direction that I want it to. So, so I'm going to say what sells for,
Mm-hmm. Yep.
and cost to build. So
Yep.
if you're going to sell a home for $200,000, right? Let's say that's 200, and it may only cost you 100. So the cost to build is 100. We'll put that here since I don't have a lot of space,
Mm-hmm.
right? So it may cost you 100,000 to build a house that could sell for 200,000. But
Mm-hmm.
what about to build if you want to sell a house for 500,000? Or
Mm-hmm.
actually, I'll use a number that rolls. Let's just use 4. That way it's just a straight up double. So let's say we want to do 400,000. Well, that should cost twice as much to build, right, Nathan? If it's 100,000 to build a $200,000 house, should it cost 200,000 to build a 400,000?
I hope everybody says no. It
Yeah,
shouldn't.
right. No, it shouldn't, and it doesn't. And that's what everyone has to remember, is it may only cost 150, and let's say 200 and
Mm-hmm.
250. So you all of a sudden you get a big jump here, and that's what the builder is looking at. I can sell a $400,000 house and make 100, or 250,000 in profit, versus selling a $200,000 house and only making 100 in profit. And it doesn't take really that much more time. It doesn't cost that much more money. There's a lot more profit in there. So, and there's the huge demand, because that's what, at the end of the day, that's what's going to drive their decision is, can I sell the $400,000 house? And
Right.
there's a huge demand. Everybody, we've grown as a society. Look back at houses built in the 50s. They were maybe 3 or 4 bedroom, or 3 or 4
Yep.
rooms. There might be
Yep.
2 bedrooms
Rooms.
and 1
Yep.
bathroom.
Yep.
There was no dining room. There was no formal living room. There was no finished basement. There was no she shed or man cave, and
Right.
we have more of an appetite for those things now. So builders can build these bigger houses, and they can do so for less money. So that's why the affordability comes into play, where you're not going to see new construction come down in price, even if lumber does come down in price, even if labor does come down in price, even if they can get the land a little cheaper, as long as there's a demand for this higher price point that they can make more profit. And that's for the consumer, that's the takeaway is, am I going to see prices come down? Should I buy this home today for 400,000 when next year maybe this home will only be 300? And the reality is no, it won't. You're not going to see, the consumer's not going to feel that reduction in labor costs or lumber costs. They're only going to see higher profit to the builder. What do you think on
Yep.
that? That was my take on it. What do you think?
You know what? I'm with you the entire way on that one, and it only because I read a couple different articles and a couple of different economic impact studies, and also the Federal Reserve economic data, FRED.
Mm-hmm.
Right? If you go to the FRED website, I love just kind of poking around on there. The reality is, certain things have to back off or go backwards for there to be a price reduction crash. Right? The cost of doing the business has to drastically fall down, which then would require demand. The general populace would have to say, whoa, hold on, it doesn't cost you that much. Like I don't want that new build. The problem is our demand for actual housing will continue to go up. New builds are a part of that. The demand structure looks like, well, frankly, we have a lot of people living good, long lives, and the millennials are ready to buy, so the pressure just keeps going up and up and up. So we're looking at it. I think the only thing that would slow down, and you hit on this in the very top, is the affordability function. If the interest rates get above 3.75 to 4% for a new build, based on your chart right there, $400,000 at 4% is a very different payment than $400,000 at 3.25%, right? And so you start looking at that calculation on the mortgage, and now all of a sudden I can't afford it. So now my demand, right? Supply and demand curves come into play here every single time. The demand for the $400,000 house by those that are ready to move, buy, start their family, whatever they're doing, is going to pivot, and that demand will start making the builder go, okay, well, hold on. If we start sitting on more inventory, we're not clearing out our debts. We're not, right? So they do a lot of these builds on debt, and then they pay them off. They sell the house, they pay them off, they take their little bit of money, they reinvest, they go back into the next thing. If that sits too long, then we have builders, now they're in real big trouble. So they're not going to do that again. So, yep, I see what you got there going. Love it. You've got colors on yours?
I did. That's a new update. No, you do. You just have to do the update on it, and it'll be in there. It's only on the export. You don't see it on your screen. So, but yeah. Right. And if you want to explain to everybody what I just drew, since you're on the roll, go right ahead.
Well, no, I mean supply and demand. You have it right there. So you're showing that as the rates start low, but they go high. With low rates, you can have higher prices. The moment the rates go higher, you have this affordability, and that's where the middle of your X is kind of like that affordability position. Now that pivots based on where we are on that line. So if rates go higher, prices have to go down for that cross point to still be where people are approved for, right? Based on current economic trends, based on how much they're getting paid on their income and the structure there. So affordability is the key term when it comes to price differentials.
Throwing all kinds of colors on there now. So yep, that's the thing is, so what happens though is it's also how big is that pool? And you mentioned millennials before. So for a few years ago, and it really was a few years ago, just maybe 2 or 3 years ago, we saw article after article. These lazy millennials, they live at home with their parents, they're not buying houses. Well, what those lazy millennials were doing is not really being lazy. They were packing away money. And they were saving money. And I'm having this conversation with my Gen Zer, my daughter, who is not a millennial. She's Gen Z, but she's 24. And she said, Dad, I want to start looking at buying a house. And I said, fantastic. And we talked about that all that money that they were putting away was to buy a bigger, nicer house than the quote unquote starter house. Nathan, I think you're a few years younger than me, but maybe not a ton. Mm-hmm. I remember my parents, they started with a starter house. You had a small house, and that was a starter house. And that was your first home. And it was it was the equivalent of today's tiny home. Our parents' generation, they had the first tiny home. It was really tiny, and you would have 6 kids in this little house, and that was the way that it was. And then if things were good, they could get to that next home and that bigger home and their move up home. And there's a lot less starter homes out there today. And the millennials were just kind of living at home, putting away the money so they could skip the starter home and jump right to the maybe forever home, or at least I'm here for a long time home. And that's what we're seeing is there's a huge demand for starter homes, but there are no starter homes anymore. There's very, very few. Where do you live again exactly? Because are you in Texas, and which part of Texas are you in?
I'm just west of Denison. So Sherman, Denison, Texas, near Lake Texoma.
What's that market like for do you have anything that's sub 200,000 right now?
Yes, but to your point, exactly. I'm a child of 1980, right? So I'm 41, and I remember the house I grew up in was my parents' starter home. It was the first house they bought, and it was 1,400 square feet, and we had a big backyard. And they moved out of it when I was 30, 28. It's like they finally moved up. But you're 100% right. One of the things I think that's causing the unaffordability, or there's not even the starter home, is a lot of those houses, and my parents did this too, they moved and they kept it as a rental. And so a
Mhm.
lot of these smaller homes were kept as rentals. They're not on the market. They're not, and if they are on the market, they're being bought up by other investors for rental property. And so
Right.
your starter home has definitely changed. My first house was that, just like you said, 1950 L-shaped ranch, 3 bedroom, 1.5 bath, right, with a kitchen slash dining room and a living room. And that was it. It was perfect. I loved it. But that was my starter home. Since then, you're absolutely correct. I think the demand and the supply is not even the demand, but the supply that's out there is either a new construction or the set what we would previously considered a second home is what's available.
Yeah. And what I've seen is so like my in-laws, they were from a place in New Jersey called Lake Hiawatha, and that was literally a lake community back in the 50s, and they had small tiny houses around the lake, and people from New York would go to this lake community in the summer and they would summer there. And
Yep.
what happened is everyone thinks that the housing crunch is a new thing. We kind of don't realize, but when you step back, these little tiny bungalows have since been renovated or literally just knocked down. And now you've got big houses on little tiny pieces of land where there was a bungalow, and you've got almost no yard, but there's a big house. And that's what a lot of the housing has become. So these starter homes, these little bungalow homes that people would buy as a starter home, those are gone. They've all been
Yep.
added on to or demolished and rebuilt. And that's kind of where our housing has grown. Is we went from these little spots and places to a lot more of these bigger houses, and people didn't necessarily feel the crunch the way they do today with the offers and the inventory, but we've run out of that now. That's what we're feeling. Is
Mm-hmm.
people don't have the option to just build on. And that's why the other thing that I think is we're seeing is the internet has opened up the ability for people to work in places they couldn't work before. So a local economy, you had to have the jobs that could support the home prices. And if the jobs
Bingo.
could only support a local community of $150,000 homes, let's say, that was what they supported. Well, I'm in an area of North Carolina, in Western North Carolina, and there's a lot of frustrated people that have lived here for generations that feel like they're being priced out because
Mm-hmm.
people like me come in here, and I've got this wonderful thing called the internet that allows me to run our business and still live in a beautiful place, and
Mm-hmm.
I'm able to afford a higher ticket price because of that. And that's what a lot of people are encountering now too. So all of those things, I think a lot of the big takeaway here is, if you were thinking of buying a house but you're afraid, I'm buying at the top, I'm going to lose if I buy now, I don't feel that way. Do you feel that way?
No, not at all. Which is why I sold and bought, this summer. It was the right move. I still think we're on a trajectory. And here, I'll share my screen real quick. Based on Fred, I've been looking at screen two. There it is. I've been looking at this chart here, right? So this is December. This is back in 2020, and this is the existing home sales housing inventory, right? So we had a lot of inventory. We lost a lot of inventory. Below 1,040,000. We peaked back up right about July of 2021. We saw some crazy stuff going on this summer, but look, we're heading back down. So existing home inventory to sell is slowing down, which again, supply demand, right? So, or whichever way you're seeing my camera, I should fix my hands, but supply and demand, right? When supply goes down, demand goes, and demand is still high, prices continue to raise because what people are willing to pay for that. Yeah, I think we're going to be in this bucket for a while, and I don't think we're anywhere near the height. I also would agree with you. And just when I started in lending in '07, that's when I lived through the crush, and it's so different now because it's not based
Yeah.
on making loans. I've been teaching compliance for a while, and the compliance that is out there now for lending is hard. People talk about, hey, it's really hard to get my loan. I have to jump all these hoops. Underwriting does this, underwriting does that. I have to do these. I have to sign all these documents 17 different times. Yeah, that's all kind of residual return from the SAFE Act coming out of the compliance meltdown or the mortgage meltdown. So I think lending's strong. People that are getting their loans can afford them.
Yeah.
We don't have as many non-qualified mortgages. We have affordability factors that they have to play into. So the mortgages are secure. I don't think we're heading to a crash. we might head to a slight slowdown in valuation increases, which would be awesome. I think
Right.
that would be actually a good thing.
And you
But I
could
don't
see a
think we're
pullback in some pockets, some
areas.
areas of the country, certain
Right.
price ranges. You could see a little bit because remember, it is on supply and demand. So as demand diminishes, then all of a sudden you'll
Yep.
have, well, price can't continue to go up, or maybe I want to get rid of my house quickly for some reason. I'm actually going to come down a little, but even that it'll be small and it'll be in areas that maybe did get overheated and where you were
Right.
forced into it. Anybody that if you're buying a house, your intention should be to be there for more than a year. You should be there for,
Mm-hmm.
I'm thinking, at least 3 years. So even if you
Yep.
see a little bit of a pullback, once 3 years go by, you won't. I don't think you would be negative. You'll then move positive again. It was a I'm going to call it once in a generation, maybe once in a lifetime thing that happened in 2008, where we had very new financial instruments. That was, remember, the internet changed our world in so many ways. One of the ways it changed the world was the way financial instruments changed. Specifically, we created these collateralized debt obligations as part of a much larger change in our structure, in our financial structure, and the way stocks are done. And anyway, it was because of that it opened the door and the appetite for Wall Street. They wanted to buy more mortgages and more mortgages, so they kept telling us,
Mm-hmm.
lower your guidelines, make it easier, give us more mortgages.
Mm-hmm.
And that's where we
Mm-hmm.
fell into a trap, and we were lending to people that were really not able to pay it back. And that's what caused what I think truly is a once in a lifetime, crash in the market. And we had a good 10-year window where anybody that bought a house between 2010 and 2020, I bought my house now in 2017 for $415,000. It's
Mm-hmm.
probably worth almost double that. I would say at least 700, and I don't think that it'll go down. I feel very lucky that I got in at that time frame. But if I had to buy it again today at 700,000, I would feel comfortable that I was going to retain my money, and that in 5 years it's going to be worth 800,000. So
Yep.
there was a great window for some people that got in. If you didn't get in on that window, don't worry about it. It's still a fantastic time to buy, and I
I
don't think there's going to be people losing.
No, I agree. And I will say I bought in '06. October of '06 is when we bought our first house, that starter home. And I still, while it wasn't the best choice and we did get hammered by the recession, it has laid the groundwork for everything I've been able to do since then. I came out of it. It took me longer, but I got out of it perfectly with money in my pocket to invest in my next property. And it was, so I will always articulate that I don't think it's a bad idea to buy a home when you are ready to buy a home.
Yeah,
Keywords,
absolutely.
ready to buy a home. So, all right, man, I've kept you longer. Thanks for just
Yep.
kind of
No, thanks for chatting
cutting
with me
through
on
this
that. That
with
was
me
fun.
and having a good conversation.
Absolutely. So, and again, if anybody wants to listen about rates, we're here every week. We'll talk about it each Monday. I think we're still going to stick
Yep.
to Mondays for a little while and see how that goes. And
Yep.
as consumers, if you'd like to see where rates are going and ask us any questions in the group, I'll be more than happy to answer them for you.
I love it, man. Thank you so much. I hope everybody has a great week. Enjoy this first week of 2022 back at work. And I don't know if kids are back at school yet, but it's soon, right?
That's another topic. Yeah, it depends on
I know.
where.
Depends on where. So, all right, man. Take care. We'll talk later.
Bye bye.